Okay, folks, so it's getting extremely violent in pretty much every sense of the word. Over the last week, you've seen stronger and more consistent red days. And at the same time, you've seen stronger and stronger concentration into a lot of these short squeeze plays that come out of nowhere and run 100 to 200%. And so, of course, in this video, number one, I want to talk about an update on plays, the latest and what you need to know, as well as, of course, AMC's update. And number two, I want to talk about three big problems that the stock market is trying to deal with right now, and hopefully that can give you some indication of what's next. And the only thing that I ask in return for all of this is that you hit that ravishing like button, and also don't forget to subscribe either. Okay, let me go ahead and get my tea. Okay, so we got really lucky with our Carve play today. Let's go ahead and start with that one. We briefed on Carve 30 minutes prior to market open as a short attack play. And why did I brief on it? Well, there's three main reasons. Extremely high short interest. Data shows 68% of the shares are sold short. Number two, it was receiving tons of social sentiment volume from retail traders. And the third and biggest reason that we briefed on it was because that momentum in the pre-market was so aggressively strong that combined with that massive short interest, I felt that the probability of this running after market open was extremely high. And that is actually what ended up happening. It actually sold off for the last 30 minutes of pre-market, but then it went from 1670 to 3887, which is of course more than doubling at highs. It then got volatility halted, unfortunately. If it wasn't for the volatility halt, based on the momentum and exponential scale of how short squeezing works, I would have expected this to hit $50 or $55 within the span of a couple more minutes. But that's okay, the volatility halt killed that. But nonetheless, I would never complain about it doubling, and it actually had a second opportunity later on in the day where it sold off dramatically after that halt, and then it rallied again back up to close to those highs. So very aggressive and very lucky play, but shout out to folks who caught this. You really earned this play. But by the way, in terms of finding these plays yourself, well, in a video that we did about 8 days ago, I talked about how we found that MRIN runner prior to much of its running as well. MRIN was, of course, a much more impressive play, but the reasons were the same. The reason that I liked MRIN at $4 and why we continued briefing on it last week as it ran up to 28, even when we were on vacation, by the way, we were still briefing because Charlie is obsessed with work, is specifically because it had the short interest and the retail momentum to perform well at that time. And this is pretty much the same exact cycle that we saw with Carve today. Same story, different stock. But remember, folks, these are pretty damn dangerous plays. I mean, you're playing with fire. And even the best runners, including Carve, aren't going to run forever. In fact, Carve already started selling off towards the after hours. When used properly, fire can be very, very helpful to cook your food or heat up your house. But when allowed to go and burn down your damn house, it's a disaster. So make sure, folks, that you understand if you're going to play with these types of stocks that have this massive potential, you have to make sure that you're having concrete entry and exit plans that are controlling your risk. But really, in terms of the first part of this, finding the actual opportunities, hey, you can get up in the morning, spend a couple hours every single day. You don't need me to do this work for you. I'm here if you need me. We're not going anywhere. But get up a couple hours before market open and fill out a spreadsheet of what's running, why it's running, and then what happens to it later on. And then after a couple of weeks, you can look back on that spreadsheet and see trading patterns of behavior and figure out if you can extrapolate those to exploit future trading patterns of behavior. And then, of course, you do have to keep following up on this because market conditions rotate, and what worked 3 months ago may not work 3 months from now. So you have to make sure that you're really, really careful in terms of constantly keeping up with it. But other than that, these are things that you can do on your own. Your brain and your consistent effort is really your best resource. We have other resources for you here on the channel and, of course, in our briefings every day. But that's just a resource that we offer for folks who need that extra push and that extra structure. In terms of other briefing plays, ARPA was fairly interesting. They had been upgraded to a buy with a $22 price target by some prominent analysts, which is something that I look for. I like to look for huge analyst upgrades. I made the judgment call 30 minutes prior to market open that the likelihood of enthusiasm coming back was very, very strong based on the circulation of this prominent analyst release. It sold off into open, then went from 223 to 332, which is about a 50% jump from market open or 40% from the briefing price, give or take. A bit of a tease though, perhaps there's some more steam left tomorrow or next week, we'll see. But hey, not a terrible play. Of course, our fear hedge UVXY we like to post whenever market volatility is going up. Today, fear pretty much peaked in the pre-market and then it sold off, so it wasn't super exciting today, but it's always important to have that in your toolbox. You want another one of our short squeeze candidates, jumped after selling off into open, about 30% rally today. The other one was Test. We briefed on it because of a good report at 7 a share. It tried to go up a few percent and then it went down a few percent. Pretty bleh. Next, moving on to AMC. So AMC had a dramatic sell-off this morning and then a bounce and then more selling off and then another bounce. closing up 6% on the day. Overall, though, it found some support right below 40, similar to where it's found previous support the last few times it had huge drops like this. Now, one of the risks that we speculated on a couple of weeks ago was that if short sellers have this go down too quickly, you're going to create a massive incentive for more retail traders to buy in really quickly. There's a lot of apes and a lot of ape capital that loves the AMC setup, but they don't want to pay really high prices, or they don't want to pay prices that are near all-time highs. They want to pay for it at a much more de-risked price. That way they have more upside if things go right, and they have a lot less downside if things go wrong. There's just more apes willing to buy in when this goes back down to that lower support level. At the same time, I have to be real here. There's a lot of leveraged hedge funds that have a lot of money on the line trying to get this down as close to zero as possible, and they think it's going to happen. And the only thing that's stopping that from happening is retail continuing to show up. But of course, as always, if something happens and for some reason there's a stampede of retail out of AMC, and there's just one domino of retail traders that decide, you know what, I don't want to deal with this anymore, and that domino falls, maybe another domino of retail traders decide, you know what, I don't want to do this anymore, and then that falls. At the end of the day, AMC can take some retail traders bailing. But hedge funds are betting on stampedes. Retail traders are betting that retail traders are going to keep showing up. And it's really just an active battleground to see what happens, and if the psychological tricks that hedge funds are playing on the retail trader actually pay off. And it's a very interesting social dynamic, because if retail traders decide to start bailing, that's going to screw over other retail traders who may be less enthusiastic about the movement, and then they bail as well. It certainly could create a domino effect, and you have to be really well aware that there's a lot of different factors here, and this is a very active battleground. But again, when you're talking active battlegrounds like this, and you're not talking about any sort of fundamental basis for a stock, you know, what you're talking about is just pure chart war. Like, sure, one group may have more troops and look more likely to win and have the strategic advantage, but for all they know, the opponent army may have some secret nuclear bomb that they never even knew about in the first place. At the end of the day, ooga booga, folks. But you have to make sure that you're accountable to yourself. It's great to stick some fingers to the hedge funds, but at the end of the day, you do have to live with the consequences of that, both good or bad. So only take on risk that you're willing to take on and you're willing to see realized. Okay, moving on. So the main point of this video is, hey, it's been a very red day. It started very aggressively red in the morning, and then it pushed back a little bit more towards the upside. Pretty much everything's down. The ARK fund, the Dow, the S&P, the NASDAQ, the Russies. Pretty damn fussy and fuddy day, if you ask me. And that's what leads me to the point of this video. So there are about 3 big negative catalysts right now that you want to know about, because they are going to be a very consistent theme over the upcoming weeks and months. Number 1, job fulfillment problems. There is a massive labor shortage. We know this. But let me elaborate. So right now, the economy is trying to get back on the ground. Demand is bouncing back huge. There's ample liquidity. People are spending like there's no tomorrow. Consumer demand is back huge. People feel confident in their future. But now as all this demand is bouncing back, employees themselves, actual people to do the labor, those folks are getting harder and harder to find. Lots of employees have shifted careers, and many others want to be paid a lot more in order to do the same jobs, which, to be fair, I mean, come on. I mean, everything's more expensive. Obviously, you want to be paid more. But still, the structural adjustment in the economy is having a lot of negative implications in the short run. This is causing many businesses, especially businesses that were doing bad in the pandemic and had a lot to bounce back from that, to struggle, like restaurants, airline, hospitality. Lots of service-based jobs are having a really hard time finding employees. And when you have stocks that are factoring in huge growth post-pandemic because of roaring demand, and all these companies are starting to have trouble actually even finding employees to fulfill this demand, well, people are starting to freak out a little bit. Without workers, companies anticipating huge demand aren't actually going to be able to meet and profit off that demand. And if they don't meet demand, they're not going to meet all these expectations that investors set for the upcoming quarters and factored into the stock prices. So as companies struggle with finding employees, you're seeing some reasonable selling off in a lot of these indices that are at all-time highs, as well as some of the other stocks that were recently trying to catch up to all-time highs. The market's trying to figure out how bad this labor shortage is going to be. Now, personally, I think that some of the concentrated labor shortages in the highly skilled categories of the economy are going to take a while to fix. We've had trouble in the highly skilled labor market for years before the pandemic, and we're still going to have it afterwards. It's really difficult to solve that problem. You can't just raise wages and get more highly skilled workers. You have to actually train them, and it takes a while to train them. But the lower skilled labor shortage is really not a labor shortage, it's more of a wage shortage. Lower skilled workers who work in a lot of service industries need to be paid more for them to come back to work and actually be incentivized to come back to work. Those are jobs that are going to come back when businesses finally feel confident enough to raise wages to actually bring in those workers. Right now, they're coming from the pandemic. Truth be told, a lot of them are coming from very shaky grounds, and they want to ease into it slowly. But they're finding a workforce that wants top dollar. So with workers having a lot of bargaining power here, you have to wait for those businesses to actually get on the ground where they're like, okay, we have a lot of demand here. We're going to go ahead and raise the wages so that we can service that demand because we know that there's a very strong likelihood of a high return if we do that. We're going to start seeing a lot of those wages go up into the fall and winter, and obviously that's going to have some other unintended consequences in terms of price increases across the board, but that's a whole nother issue. So I would expect a lot of these labor shortage issues to be somewhat short term. I think 3 to 6 months is about what you're looking at, and the stock market likes to factor in things ahead of time, so we'll see what happens. Okay, number 2, the second reason that we're in a little bit of a FUD territory right now is the Delta. So you've seen the Delta variant making headlines for the last couple of months, really. And of course, what we are seeing is once again some restrictions being implemented in many of our trading partners. You have Norway delaying their full reopening. You have lockdowns in countries that never really had lockdowns. You obviously had China implementing on and off huge restrictions to deal with their variants. You had, of course, Russia shutting down their capital city a few weeks back. You have huge waves of cases in many other countries in Asia. And obviously in the United States, we've seen almost across the board, everything's reopening and trending in the right direction. But regardless of what we're doing here, if our trading partners start going into this restriction mode, even for a short-term to medium-term time span, that's going to freak out a lot of the businesses that trade with those countries. And of course, you're going to have some people that are like, okay, well, what if it spreads to some of the more willing to lock down states that also happen to be some of the biggest economies in the United States, like California and New York. The third thing, and what we talked about yesterday, is this China FUD situation. There's simply a lot of companies that are under enhanced anxiety due to the back and forth drama with the US and China, regulators in China, and some transparency issues with select companies like DD. People are extrapolating that to extend to all companies in China, which is causing a lot of sell-offs that's also hitting tech. And those are really the 3 pieces of FUD. But I think that the perspective here is that all 3 of these negative market catalysts, they all have a high likelihood of being mostly short to medium term, which means perhaps, hey, maybe this doesn't turn into a whole other stock market storm 2.0, but just some short-term FUD. But anyways, we'll see what happens and we'll keep you updated. Anyways, folks, that caps off the video. If you have any questions, feel free to reach out to us below or join us on ZipTrader Circle. And of course, quick plug, if you'd like to learn how to trade, would like access to our private chat and daily morning briefings where we brief on all the biggest catalysts each and every morning, well, I'll go ahead and put a link to ZipTrader U below. But folks, please only join us if you're going to commit yourself to the process, practicing paper trading with every single concept and then never giving up when times get tough. The program was thoughtfully created to give you a process to learn and grow, but if you don't complete the structure and dedicate yourself to doing every single lesson and doing it as and completing it as designed, then you're not going to get anywhere. When I buy something, I make sure that I'm going to get my money's worth out of it. So I expect you to do the same. And if you'd like to take the leap and join us, I'll go ahead and put a coupon code in the description below. Battlefield75 will get you $75 off before checkout. You just put it in the little add coupon code spot before checkout. And if you're wondering what broker to trade these stocks on, we always like to send new traders over to Webull. I'll put a link to them below as well. And signing up and depositing with the link below will also get you some free stocks. Anyways, have a great day and I'll see you in the next video.